Hi, welcome everyone to the post-budget webinar for TC Group, Rebuilding Britain. What's the impact on you? There's plenty to cover off, I think it's fair to say. It's obviously been a week since the budget announcements last Wednesday. Quite a lot of noise has already been made about some of the key changes. I think it's fair to say. I think having a week as well since the original budget, I think there's also a fair bit of detail which some actually hasn't been picked up in the mainstream media. So we fully intend to cover off all the main changes which have been announced, as well as some of the sort of detail which perhaps hasn't had such a wide narrative. And we want to try and make it a bit interactive as well. So we've given everyone the opportunity to provide questions beforehand. So thank you to all those people that have done that. If there's any questions you have as we go through, please do use the facility on Zoom so we can take questions throughout as well. I've got a colleague who'll be monitoring those questions, and we'll try to get through as many as we can. In terms of format, I'll be chairing it. So I'm Steve Watts, who's one of the regional managing partners here at TC Group. I'm joined by some colleagues in our tax team. So we've got Debbie Ince, Trevor Shaw. I'm joined by Patrick Forehun in our corporate finance team, and then Simon Perkins from a financial planning, pensions, investments angle. So we should have all the main areas covered. Timing wise, we're looking at an hour, so 3 till 4. I will try to keep, well, my main job is to keep it to 3 till 4, so I actually intend to finish at 4. So without any further ado, I will move on. So this gives you a bit of an idea of all the taxes we're going to cover. A lot of, I think it's fair to say that one or two areas on here on the agenda there wasn't much of an update, so there wasn't many changes announced. So we won't need to spend as much time on some areas, but alternatively on other areas there was quite a lot of announcements, so we'll end up spending probably more time on those areas. So I'll hand over to Debbie. Debbie, do you want to start with income tax?
Yeah, thanks very much, Steve. Good afternoon, everybody. I'm going to take you through the income tax side of things post-budget. As Steve mentioned, this is actually one of the areas where there weren't as many changes as we expected to be. I think it's fair to say, certainly I personally thought that the dividend rates would change in this budget. I think you'll all have heard a lot about the Labour's tag on working people and the fact that they committed not to increase tax rates for working people. And I think it would be fairly easy to say that a dividend didn't necessarily apply to a working person. I'm sure there are many people on this call who will disagree with that, but I do think it would have been something that they could have put an argument around. So let's just start at the top then. Obviously no changes to the basic, higher and additional rate tax band. So for income tax, you're looking at 20, 40 and 45%. For dividends, they are slightly lower and they are unchanged. As I say, a surprise there certainly for me, but they remain at 8.75%, 33.75% and 39.35%. And I think one point I'd make around the dividend tax rate is that certainly for income tax or for any tax, dividend taxes in the basic rate band remain the lowest rate of tax you will pay. And I think a lot of people miss that. I think people get hung up on capital gains tax rates and the 10% rate as it is or has been. And I think people miss that dividend rate being 8.75%. Something to bear in mind. Personal allowance threshold, that remains frozen until 2027-28. And then after that, the suggestion was that the personal allowance will increase by inflation. I know we've had some debate within the team about how strong the commitment was to that, but from 28-29, the suggestion was that the personal allowance will start to increase again by inflation. So I think that's just a whistle stop on the income tax side.
We've had just a question coming actually, which I know is actually covered off in the second half, which is more around the planning opportunities. But just a question we can perhaps touch upon now and maybe revisit is around business owners being remunerated from their companies, because the NI changed, and again, we're sort of getting into other territory, but because the national insurance changed and dividends didn't, does that make it more attractive now to take your remuneration from your company as dividend as opposed to salary?
Yes, I won't go through it too much because, as you say, Steve, we are going to touch on that later. But yes, we've run some numbers, and certainly the differential between a dividend and a salary had got much tighter. And in some situations, it was better to take a salary. On the numbers we've run so far, taking a dividend now is again more attractive than it was, and so therefore it's attractive to take dividends going forwards. But we will cover that in more detail for anyone who wants that in the second half of the presentation.
Thanks, Deb.
Okay, just moving on to national insurance then, and I think this was probably for some people the big change, particularly for any of you with businesses who are employing people, because this will have a direct cost to employers with employees. The main rate of national insurance that employers pay is going to increase from 13.8% to 15% as of next 6th of April. And the rate at which the employer will start to pay the tax is reducing from £9,100 to £5,000. So not only have you got the increase in the tax rate, you've also got the reduction at the point at which that national insurance is being paid. So essentially a double whammy there. We've run some numbers, and for the average employee, now we Googled this, and the average employee apparently earns £36,000 a year. But for that person, the cost for the employer, the additional cost of employing that person will be £1,000. So clearly, 10 people, £10,000 extra cost, and obviously increasing it up from there. So that's something that's going to have an immediate, or as of next 6th of April, impact on employers and their cost base. So with regard to the employment allowance, which some of you will be aware is an allowance essentially against national insurance, that's going to increase from £5,000 to £10,500. So some protection against the change, but obviously for the larger employer with more employees, they're clearly not going to shelter all of the increase with that extra employment allowance. So definitely, I think one of the things that, certainly in conversations we've had with clients, is going to be a significant impact on people employing individuals. And then we'll move on to domicile. So domicile, I'm sure many of you have heard an awful lot about domicile over the years, particularly with our previous Prime Minister, and much of the talk with regard to his wife's situation. She was a non-domicile, you might remember. So essentially, non-domiciles until now have had a tax advantageous position in that for a period when they come to the UK, if an individual is non-domiciled, they haven't necessarily had to pay tax on their worldwide income, and instead just paid tax on their UK income. And clearly that's led to some discussion and debate about the fairness or otherwise of that. So the Conservative former government earlier this year had said that they would make some changes. And there was much talk, obviously, before that and since from the Labour Party about what they might do. So last week they announced that they effectively will now abolish the domicile tax regime as of next April. So there's no transitional reliefs, there's no temporary reliefs that they've mentioned. The domicile position will just be abolished and will be replaced with a residency-based regime. Now, we haven't seen the detail behind that, I'm afraid, so we don't know exactly how that will work. But my assumption is that anybody who meets the residence test in the UK will fall into the UK tax net for their worldwide income. So that could be considerably different for individuals who, in the past, have been able to take advantage, as I say, of keeping their non-UK income outside of the UK tax net. The other implication of this as well is that it removes the possibility of using offshore trusts to keep assets outside the UK and therefore outside the scope of UK inheritance tax for a non-domiciled individual. So for anyone who isn't domiciled in the UK, that's obviously quite a significant change for their tax position potentially going forwards. And around that, therefore, has been much debate about whether those individuals might choose to leave the UK and possibly move to a more tax advantaged jurisdiction. But again, we can probably pick that up later in the planning section or the questions after, if anyone wants to.
Thanks, Debbie. Whilst you're talking, a couple of questions come in. One on NI, which will thanks to the individual who asked that question. It was around the cost of businesses, but the question went on to ask about the impact on businesses which have a number of employees on national minimum wage. So we'll cover that off at the end. So thanks for that question. Okay. Another question just coming on non-dom. So we'll cover that off at the end. So thanks for that. And thanks, Debbie. Moving on to Trevor.
Good afternoon, everybody. So on corporation tax, the good news is that the government haven't changed any of the rules on corporation tax. They've promised to maintain the rate of corporation tax at 25% for the life of the Parliament. And also, more importantly, they've kept the capital allowance reliefs, the £1 million annual investment allowance and the full expensing allowance. These effectively mean that for every pound you spend on qualifying plant and machinery, you get £1 off of your taxable profits. So definitely an incentive there for businesses to keep investing in plant and machinery and potentially more productive machinery. Looking at capital gains tax, this is a voluntary tax, it has to be said. Why? Because you only pay it when you sell something. If you don't want to pay it, don't sell something, or alternatively, you can leave the country, choose the right location and pay a lower rate of tax. You'd have to stay out of the country for 5 years to do that though, and that can prove to be a challenge for some taxpayers. But looking at the actual changes in corporation tax or in capital gains tax rates, they've increased from 10% and 20% to 18% and 24%. Those are quite big increases. However, it just means the main rates of capital gains tax are now the same as on residential property, so buy-to-let landlords. On the sale of a business, the capital gains tax rates or business asset disposal relief has been maintained at £1 million, which is good news, and the business asset disposal rate up to the 5th of April is kept at 10%. However, next year it will be increased to 14% and the subsequent year 18%. So that will mean that businesses will have to think, or business owners will have to think about when they're going to sell their business if they want to attract the lower rates of capital gains tax when they're looking at an exit in the near future.
Thanks, Trevor. I've got a question which, apologies everyone, I think there was a bit of a freezing of screens for some of you. So I'll just repeat this question for anyone here at first time. It's probably a question for you, Patrick. Someone's asked, is there enough time, will there be enough time to conclude a trade sale prior to 5th of April when the business asset disposal reliefs increase?
It's a great question, Steve. And I think the answer is yes, but we'd probably have to get organised quite quickly. It's a question that, as you say, every client who's looking to dispose of their assets prior to the 5th of April is flagging at the moment. I think if we're looking to do an internal transaction, and what I mean by that, if you've got a business owner who's looking for a sale to their management team or looking for a sale to employees, I think the answer is certainly yes, we've got adequate time. If a client is looking for a third-party sale, so a sale to a strategic or a third-party buyer, and they're not currently known or kind of waiting in the wings, I think we've got kind of a challenge, but it's not impossible. So we'd have to source a buyer and agree kind of commercial, legal, and financial due diligence and the legal agreements prior to the 5th of April. So it's not impossible, but still we'd have to get our act together quite quickly, Steve, if we were to achieve that.
Lovely. Thank you, Patrick. Back to you, Trevor, on stamp duty.
So on stamp duty land tax, there have been a couple of increases in rates for people buying second homes or buy-to-let landlords, but probably the one that didn't make sense to me in the budget was the withdrawal of the temporary relief for first-time buyers. There is still a relief, but it's greatly reduced. For a government that's looking to encourage property acquisition, home acquisition, it does seem like a slightly backwards step, that one.
Thanks, Joe. We're getting quite a few questions through, so thanks for everyone. Keep asking them. I haven't overlooked them. We'll pick them up at the end of the end of the webinar. We've allowed 10-15 minutes at the end for questions. So yeah, moving on, Debbie.
Thanks, Steve. Yeah, so I'm going to pick up on inheritance tax. And again, I think everyone will be aware that this was one of the areas in which there was quite a lot of change and has certainly provoked an awful lot of discussion post budget. So the NIC band has been £325,000 for quite a while, and that will continue until 2030. So just as background, the nil rate band is essentially the amount of your estate the amount of assets in your estate that when you pass away won't be subject to inheritance tax. But that was, say, one of the few things that we didn't change on inheritance tax. So we're in a position now, or we will be from 2027, where inherited pensions are going to be included in the inheritance tax net. Now, that's obviously quite a change because at the moment, inherited pensions aren't included in the inheritance tax net, which has meant that a lot of people have probably piled money into a pension to be able to get assets outside of their estate. And clearly, if they're in a position where they have a significant amount of money in their pension, bringing that within the inheritance tax net will directly have impact on their estate. I met a client the other day who immediately has a significant additional potential inheritance tax bill that he or his estate, and certainly then his beneficiaries, are facing. The other change that you'll probably have seen an awful lot about on the news and in the press is the changes to agricultural property relief, business property relief. So essentially at the moment, if you have a farm or a shares in a trading company, for example, and they are genuine businesses, then subject to some potential exemptions, they will effectively get 100% relief from inheritance tax. So whether that be on a lifetime transfer or ultimately when you pass away and through your estate, those assets would not have been brought into the inheritance tax charge. As of next April, and this is comes in April 2026, the relief will be limited to £1 million excuse me, on a combined basis. So if you have a farm and some business property relief, the total exemption you'll get fully is £1 million. And then after that, you'll get 50% relief. So if you, let's just say you had £2 million worth of assets, £1 million of those will qualify completely for relief. The other £1 million will only get 50% relief. So you're moving from a position where you would have had no tax to pay to obviously now being liable for inheritance tax. So that's obviously quite a big change. And I'm sure you've seen quite a lot from farmers and the protests they're planning, because for people who are perhaps asset rich but income poor, they are potentially being faced with having to sell part of a farm or even all of a farm when the individual passes away to be able to afford that inheritance tax liability. So I've certainly heard a lot in the press about the fact that kind of passing on an agricultural business, a farm, will be greatly impacted going forward. So I think that's something that you'll hear quite a lot about in the press and on the TV going forward, certainly. And then the other change is that they've now said that on AIM shares, they also will only get 50% relief. So means an effective rate of inheritance tax now of 20%, whereas in the past they'd have had full relief from inheritance tax.
Thanks, Dave. I think to say, Debbie, there's quite a lot of changes on inheritance tax. And I think one thing you just covered off now was the changes around inherited pensions, which sort of moves us on nicely to Simon to cover off some of those pension changes in a bit more detail. Simon?
Yeah, thanks, Steve, and good afternoon, everybody. Just wanted the changes in the pension legislation in regards to obviously how these affect inheritance tax going forward. So just quickly on this, there's no changes to the current annual allowance or the tax-free cash availability. And obviously that was something widely reported before the budget that may get changed. Pension death benefits proposed to be included within the estate as Debbie said, from 6th of April 2027. But we are in a consultation period at the moment, so that's currently been launched. So we're probably looking at clients in terms of advice going forward and just saying, look, we probably need to wait until the consultation period is over. And just covering off the current rules regarding the proposed rules. So obviously under the current rules, pre-age 75, death benefits are income and inheritance tax free to beneficiaries. And post-age 75, death benefits are inheritance tax free, but withdrawals were taxed in line with the beneficiary's marginal tax rate. And then if we move this forward and the rules do go ahead from April 2027, then the pre-age 75, the death benefits would still be included in the taxable estate for inheritance tax, but the income to the beneficiary would be tax-free. And then post-age 75, you've got a situation where death benefits could be hit with a double tax charge in regards to inheritance and income tax. So I think that's the bit that has got most press in regards to the budget. And I've seen quite a few calculations going on in regards to a client having to pay 40% inheritance tax and then beneficiaries inheriting that pension and then paying 40 or 45% on their marginal rate of tax. And those calculations can get percentages up around the sort of 60% mark or more. But just one issue, just to cover off, is that pension benefits would still benefit from the spousal exemption. So that's one thing that's still in force.
Simon, as expected, Simon, got a few questions on pension. I'll cover a couple off now, and then we could perhaps pick all of them, the rest at the end. Someone's asked, how do you see this altering clients' mindsets with regards to pension planning? I suspect they're referencing the capturing within inheritance tax.
Yeah, I think that the general consensus we're sort of asking clients not to make any knee-jerk reactions, and I think the other question that has come up a lot just around the consultation period is that the actual consultation period isn't very long. The consultation period is from the 30th of October to the 22nd of January. So that period is just around the corner, really. So we're asking clients really not to make any knee-jerk reactions or changes to their planning until we know for sure what the rules are going to be. However, I would say that if clients have already contacted us regarding drawing more money out of their pensions and potentially gifting that to children or gifting it via a trust.
Okay, thank you. And yeah, a couple of people have mentioned about the consultation, which you've covered off, but also someone's asked if it's January 25, is that like when it ends?
Yeah.
Have you got any idea or any thoughts on when the changes might come into effect from?
Well, I think that obviously the consultation period is for 30th of October 24 to 22nd of January 25. It depends what comes out of that consultation period, but any changes out of it won't come into effect under the current guidance until April 2027.
Okay, thank you, Simon, and thanks for everyone for those that asked those questions. I think back to you, Trev. I've got a couple more slides, and then we'll go into the tax planning opportunities.
Thanks, Steve. So on VAT, realistically, no real changes announced in the budget. The VAT on private school fees had already been pre-announced, and that will come in from the 1st of January as expected. There is some anti-avoidance rules around to stop people trying to recover that VAT on their school fees. Innovations relief, again, there's been lots talked about in the press and lots of work done before the budget in relation to R&D, so all the changes were already pre-announced, so we're not particularly expecting any change there. Grasping for a bright light in all of this, employee costs are qualifying for R&D, and therefore the increased national insurance costs will actually add to your R&D claim, so you will get some money back, but not all of it. And if you're involved in visual effects for film and television, then there's a new relief that's been announced, but we yet to see the details of that, and we'll keep you updated as and when that comes in. So
I think it's fair to, I mean, the first part of the webinar, we wanted to just cover off some of the the technical legislative changes. But I think the second half of the webinar, this is where we want to perhaps talk a bit more about some of the planning opportunities which are still in place or which may now be in place because of some of the changes announced last week. So you've already touched upon R&D, Trevor. Is it again? Many businesses on this webinar will be in sectors where they're already perhaps claiming R&D, and is it worth just spending a few minutes just reminding everyone what a generous tax relief it is? And like, I think you've already touched upon the impact of the I changes. That's all qualified expenditure, right, for R&D?
Absolutely. So the R&D release, they are being merged into one release. So going forward from next year, effectively, the tax relief you get for R&D is going to save you 10 pence for every pound you spend on qualifying R&D expenditure. So there are some benefits there for you. The one that I did want to mention is patent box. Often an overlooked relief, but if you're developing a new product or a new process, you can potentially get this patented. And if you can get it patented and you earn qualifying income from that patent, then you are entitled to the qualifying profits from that patent to be exempt from corporation tax, or at least 60% of those profits to be exempt from corporation tax. And for businesses that do lots of development and sell high value patented items, this relief could actually be more valuable than R&D relief itself. So a very valuable relief that's often overlooked by businesses because they don't want to invest in a patent, which isn't necessarily that expensive to do. Yeah. So certainly one for businesses to consider going forwards.
Thanks, Trevor. And I think it's fair to say that the R&D space has been under attack for 3-4 years now by the Treasury and HMRC. So it was welcome relief from our R&D team. That there was no changes announced. So I think that was one of the very few positives from the budget last week. I think from a business owner's point of view. Moving on now, the dividend salary. I touched upon this because I think someone asked a question around how does the changes in the increased national insurance costs on businesses and the dividend rate not changing, which again was one of the other benefits of the budget for business owners, that there's no change in dividend tax rates, like Debbie said. So Debbie, I know you started to answer this, but could you perhaps a bit more detail around, because again, a lot of people on this webinar will be business owners who are probably remunerated through a salary plus maybe more dividends. So can you just talk through what the best thing to do is and what some of the things people should perhaps be considering?
Yeah, no, fine. Thanks, Steve. So I do an awful lot of work around remuneration planning for clients, and have done for many years. So there are opportunities there for looking at the way people take their money. I guess historically, traditionally, people have taken a salary, but certainly over time, I think there has been a move more towards a lower salary and dividends. Now, we always make sure that people take a level of salary that will give them their national insurance credit. So that's quite important to do. If you're not taking a sufficient level of salary, you won't get your credit for national insurance. And essentially, I always kind of view it as being free money. So if you pay yourself the right amount of money, you'll build up your NIC record. So I think that's kind of always my starting point. One point I would make, though, is that obviously if you work full time within a business and you have a contract, whether as an employee or an officer, taking a salary, as we suggested on the slide there, of £12,500 is fine for tax, but actually it breaks employment law. So that's something really important to remember. You need to consider, if you have a contract for your role, that you have to be taking a salary that doesn't fall foul of the national minimum wage regulations. So you have to have a minimum salary now for kind of a full-time employee would be around about £23,000. So certainly on the low salary, as low as 12.5, and dividends wouldn't work if you've got a contract, would be breaking employment law rules. So that's something really important to remember. Having said that, assuming you don't have a contract and we can do the lower rate of salary, then looking at the numbers which we've run. So if your total income is within the basic rate band, And that's almost the perfect scenario to be in. So if you've got, say, a husband and wife company, and you can take a total package each of up to 50k, you can have income of up to £100,000 at a very low effective rate of tax. Because if you remember, one of the things I said first off was that the lowest rate of tax you'll get is that basic rate tax on dividends, being 0.75%. When you factor in personal allowances, etc., the effective rate of tax you will pay if you do a low salary and dividend up to £50,000 is less than 8.75%. So a very effective way to draw your money.
Thanks.
If you're keeping under £100,000 to retain your personal allowance, then the numbers we've run say that it's beneficial to draw dividends by round about £3,500. So that gap had narrowed, as I say, between salary and dividends, but it's now widened a little bit because of the implications, obviously, with the national insurance changes and the fact that dividend rates haven't changed.
Thanks, Deb. And again, what you just said there will apply equally to next year because there's no change in corporation tax next year based on current rates. Someone's asked a question, Debbie, around was there any mention or change to the I don't know how you call it, the restriction of personal allowance when you earn over 100 grand, when you get to. Yeah,
no changes. So that they will still be restricted. So for every £2 you earn over £100, your personal allowance will be restricted by £1. And although you remember at the start, I said that there were no changes to the rates. Many of you will probably be aware that if you get into that over £100,000 scenario and lose your personal allowance, you're in an effective rate of 60%. In fact, higher than that when you factor in the national insurance contributions. But yeah, it's not necessarily an ideal position to be in where you lose your personal allowance. There's also further implications, well, if you've got student loans, etc. But fair to say that losing your personal allowance is probably not the greatest planning in the world. So we would try to keep someone in a position where they're under 100k for that reason.
Thank you, Debbie. Moving on, Patrick, Trevor, you on hand to cover off the next couple of slides?
Yeah, absolutely. So looking at succession planning, so the first category here is business owners looking to pass the business on to their children. Now, obviously, one of the things that's happened in the budget is to change inheritance tax and business property relief. So instead of being 100%, as Debbie said earlier, it's reduced to 50% above £1 million. So what does that actually mean for business owners thinking about passing their business on to their children? Well, at the moment, as I said, there is an incentive to hold on to the business until death, whereas now you're guaranteeing a tax bill on death through inheritance tax. So should business owners be taking a different approach to this and saying, actually, should I be transferring the business to my children at an earlier point? If you can transfer your business and survive 7 years, then there is no inheritance tax at all. So that's actually very beneficial. And capital gains tax can be mitigated by a simple election. It is possible to pass the business on to the next generation tax-free. And I think a consequence of that is instead of business owners holding on to the business until they're 70 or 80, dying and passing it on to the children who are then 50 or 60, the business owners could pass the business on in their 50s or 60s to the next generation when they're in their 30s and 40s. And then you're bringing in a management team who've got lots of energy, lots of enthusiasm, and lots of innovation that could look to take that business forward in a slightly different way and perhaps greater productivity and greater profitability. So there is potential silver lining here if we look at the way we want to consider succession planning going forwards. Of course, not all families are lucky enough to have kids that want to take the business on, so they'll sell to management or sell to a third party. The reality is on those, the tax rates have gone up, so therefore there will be more tax to pay, but we can work with you to look to mitigate some of those costs and taxes. Patrick, could you give me your view, or give your view on the current M&A market at the moment?
Yes, thank you, Trevor. And I think, we've made a valid point around capital gains tax, is that the rumours were that the main rate were probably going to be aligned with income tax, which may have had a kind of a catastrophic impact to entrepreneurs. However, they've gone up, the main rate's gone up to 24%. So we're still expecting any activity out there. And as you alluded to, Trevor, not every owner's got children who want to take the reins. So, we typically work with owners either as soon as they start thinking about planning. And I think you're right, with the changes to business property relief now, the earlier business owners start planning for their succession, the better, because it allows us time to plan whether it's a transition to family, or it may even be a hybrid. We've worked on a couple of those recently, whereby there may be some family members in the business, some non-family member management as well, where we've worked on management buyouts, for instance, to almost satisfy the needs of the owners and the management team at a time, and also third parties. So we expect the market to remain active. We also expect, another flurry of transactions to the finish line of the 5th of April 2025 before asset disposal relief goes up as well.
One of the areas that we're working with a lot of clients isn't necessarily to reduce their tax, but actually to maximise the amount of cash they receive on sale of business. And one of the ways of looking at that is to incentivise key members of senior management. You want to keep them in the business to help the business grow, and you'd like to give them a benefit on exit. So the enterprise management incentive scheme is a share option scheme that enables business owners to give key employees the right to buy shares in the business when you sell the business. The idea behind this is if you own 100% of the business and you give key employees some shares, say up to 10% between them, then the plan is that when you sell the business, the company will be worth a lot more, say 120% what it would have been, but you've got 90%, so you're left with 108% of what you'd have had otherwise. So your cash amount goes up. Your tax may go up, but your total cash amount has gone up. And EMI schemes are a good way of doing that. They're government approved and they're highly tax incentivized, certainly for employees, because when employees sell their shares in the future and they make a gain of, say, £100,000, they will only pay tax at business asset disposal relief rates, so 18%, and there's no national insurance on it. Now, alternatively, you could decide to pay your employee a large bonus on sale. If you did that, HMRC are now saying they would question whether that is an allowable deduction against the profits of the company. And if it's not allowed, effectively, it's a very tax expensive bonus to the employees. If they receive their bonus effective through an EMI scheme, then the legislation guarantees that you get tax relief in the company for that. So highly efficient for both the company and for the employee. And not only that, if you've reduced your corporation tax bill, you can actually get more proceeds when you sell the company. So all in all, a very effective incentive arrangement for businesses. The last area we want to talk about on planning is employee ownership trusts. This is where a company is sold to an employee ownership trust, and that employee ownership trust needs to hit a number of qualifying conditions, and those include being for the benefit of all employees in the business. From the point of view of the family selling the company to the employee ownership trust, they have the benefit of a 0% tax charge, which is very good. However, going forward, there are now new restrictions on that, and there is something called a disqualifying period, which basically means if the company breaks the rules within 2 years of the sale of the business to the trust, then the 0% tax charge disappears. The bad news that's come into place is actually that 2-year period is now 5 years. So we are sat here, we're looking at a position whereby the company is sold to the trust. 4 years down the line, somebody comes along and says to the trustees, we'd like to offer you a phenomenal amount of money for the business. The trustees decide to sell, and all of a sudden, this is a disqualifying event. And so on the original share transaction, selling to the trust, which was originally 0%, that is now taxable. And that tax charge will be 24%, but could be, say, 4 years ago. Now, in addition to paying the tax, HMRC will ask for interest because the tax has now been paid late. and that could bring your effective tax rate up to about 35%. So potentially a very expensive error to make if it gets caught by the anti-avoidance rules. Patrick, could you give us your views on what's happening with employee ownership trusts at the moment?
Yeah, it's probably a slightly more optimistic view, Trevor. I still think there are fabulous exit routes for those businesses that are fit for purpose. And by fit for purpose, I mean that with due planning and execution could be perfect to be passed down to kind of a wider ownership group. As you mentioned, just look, the sellers would pay kind of 0% capital gains tax on sale. But what has come to light is that there has been kind of a consultation. The feedback of that has shown that there's been some abuse around employee ownership trusts. And now there'll be more onus on the trustees and governance of the trustees, so that the sellers genuinely lose control, and that the valuation is at market value and will be sense checked by the independent trustees or the trustees at the time of sale. So to make matters more complicated, and without going into too much detail, HMRC are no longer accepting tax clearances for EOTs, but what they haven't done is change that kind of magic kind of tax-free exit, for want of a better phrase. So they're still a viable option for businesses who are genuinely and kind of on a bona fide reasons going into employee ownership. Particularly with the main rate of capital gains tax going up to 24%, 0 versus 24% is quite a differential now. So again, if they're genuine, I still think there's a real need for them. And hopefully, as you say, the plan is that they increase productivity in the workplace, and we could all do with that, and that would kind of go on with the rhetoric from the government around growth.
Thanks, Patrick. Just whilst you're on, and then we'll move on to, we've got quite a lot of questions, so I'll try and get through as many as I can. So just a couple of questions related on EOTs, Patrick, which I think you've probably covered off. Do we expect EOT transactions to continue to be popular for business owners? And then another question just come in: impact on a business going into an EOT?
Yeah, so will they still be popular? Absolutely, Steve. The popularity has spiked significantly, and it can't be any surprise that business asset disposal relief currently is at 10% on the first million. Those who know, it used to be entrepreneurs relief for the first £10 million at 10%. So obviously the differential in tax has probably driven more people to consider EOTs. I think that will only continue. We've seen some positive, some not so positive, but some positive press around EOTs. And I think the last time I looked, we're now into the kind of thousands of EOTs, and they've been around for 10 years now. But for the first few years, there weren't many at all. So yes, we expect popularity to continue. For companies who join EOTs, so there's benefits for the sellers, but for employee-owned companies, all eligible employees can receive up to £3,600 income tax-free. It's not national insurance tax-free, but it's income tax-free, which is again is a fabulous perk for employees participating in kind of employee-owned businesses.
Thanks, Patrick. Well, that sort of concludes the main part of the webinar. We've now got enough time. We've got 10 minutes, which was bang on plan. So to do some questions. So I suppose in no particular order. Simon, my question is about the effect on pension after death, and if there are any steps to be taken to mitigate this position. Again, I think that's linked to the inheritance tax changes, isn't it? So any thoughts on that one?
Yeah, I think generally, it would be down to individual circumstances and what other assets they've got in their estate. So I think the general consensus from my point of view would be not to make any changes until we see what happens post 22nd of January, and obviously look at what assets you've got in the estate, work out what the inheritance tax liability is, and then obviously if the rules are going to come in April 2027, we've got some time to make those changes. So I think it is individual recommendations per client, Steve.
Okay, thanks, Simon. Trevor, probably a couple of, again, related questions around capital allowances and and what can qualify. So first question was, does the rebate for expenditure on plant or machinery apply to software if a software was required for the business? That's one question. Then the next question, do laptops, computers qualify as machinery in regards to the corporation tax capital allowances? So there's two questions, similar questions. You okay to pick those up?
Yeah, I can pick those up. So in essence, although I use the phrase plant and machinery, that's a bit of terminology, and I apologise for that. In essence, things like laptops, furniture, plant and machinery, anything that you use in the business is generally treated as plant and machinery. The exceptions to that are things like property and cars, but otherwise, generally speaking, they would be available. Certain things like long life assets have a restriction to them as well. And a long life asset is something that has a long period of usefulness. So it would apply for most assets that an SME or a business is looking to acquire, but not necessarily everyone.
Okay, thank you, Trevor. A couple of questions on national insurance changes. So someone, going back to the beginning of the presentation, I think it was yourself, Trevor, and Debbie, who mentioned that the cost was, on an average employee, which was 35k, the cost per employee was £1,000, I think one of you said. So someone just said that what would it be if the majority of the employees are on national living wage? Because again, there was an increase in that. So have you done any numbers yet, either of you, just to sort of have an idea of what the actual impact in percentage terms would be if you had a business who was paying national minimum wage?
I haven't. I don't know. Trevor, did anyone run any numbers for you on that? Or
I did run some numbers on it, Debbie. In essence, because you've got the interaction of the increase in national minimum wage and for the under 21s on national minimum wage, for an under 21, you are looking at an increase in cost of about £1,000 per employee. So effectively the equivalent to somebody on an average salary. And that sits predominantly because of the increase in the salary, in the minimum wage level, which has gone up significantly. And then for some national minimum wage, I think it worked out at about £700 or £800 as additional cost per employee.
So just in percentage terms, Trevor, can you quite translate that into percentage terms? So what was the increase in minimum wage as a percentage? Was it between 6 and 7%?
6 and 7% for national minimum wage, but it was higher for under 21s because they're trying to close the gap on the national minimum wage between under 21s and over 21s. So effectively, they'll get to the same rate in a few years' time. Okay, so you'll have the impact of the increase in that rate, but also the increase in employers' national insurance, and then also the reduction of the NI threshold. Yeah, so for off the top of my head, I think it's about 13-14% for national minimum wage and about 18% for those under 21. Okay, fine, thank you. Question on non-dom, Debbie, which I know is always risky asking this in a live webinar, given how complex the legislation is. So if you can't answer it, don't worry. We can deal with it afterwards. My concerns are about the end of non-remittance basis regime in April 25, as I am currently registered as a non-dom and tax resident in the UK since March 21, after my job was relocated to the UK. I understand I will automatically lose the benefit of the current regime for next tax year in April 25. Does that make sense to you?
Okay, yeah.
Yeah, okay. The question is, what are the tax implications for existing non-dom individuals in the UK if I sell shares and other overseas financial investments between now and the end of the current tax year?
Okay, so as we understand it, there are no changes to the rules until 6th of April. So capital gains tax is based on where you're resident, but having said that, there are these reliefs for people who are not domiciled in the UK. I would need to understand more about the individual circumstances, because after you've been in the UK for a period of time, your ability not to declare income and gains disappears and can be replaced by, instead you making a payment essentially instead of having to declare or taxes. So if you're not remitting income and gains, then there can be ways in which it isn't put into the UK tax net, but that might be something to take kind of offline, away from this webinar. The other point I would make though, Steve, is because the person who raised the question made reference to being registered for domicile. Generally, you can't register for domicile. They might be completing their return on the basis they're non-domiciled. I'm just not. I don't quite understand the reference to registering for non-domicile either. So that's something probably we need to clarify.
Well, thanks for being brave enough to ask questions. I didn't actually understand the question at all, but thanks for that, Debbie. Appreciate that. A couple more questions. EOTs, is the new 5-year anti-avoidance rule for transactions post 30th of October, which is when the budget was? So, or do they bite in on previous transactions that were so the last 2 years? Okay, so I understand the question. So are they retrospective, Trevor, is the question, I suppose?
So the short answer to that is they only apply to transfers to employee ownership trusts on or after budget day. So it's not retrospective, it only applies to the ones going forward. So if you set up your employee ownership trust at the beginning of October, you're fine. If you set it up at the beginning of November, you're caught by the new rules. Okay, fine. Question here. My question is, what planning opportunities can one adopt to minimise the impact of IH inheritance tax changes on the trading business? So probably Debbie.
Yeah, okay, no, fine, I'll pick that up. Thanks, Steve. So I think we've always wanted people to look at planning for inheritance tax and any planning, to be honest, at an early stage. So I think that's one point that I'd want to make. But there have always been issues potentially around business property relief. So if, for example, you're carrying a lot of cash on your balance sheet, you wouldn't always necessarily get full business property relief, which is why I made the point when I did the IHT section earlier about the fact that most of the time people might get full business property relief. So I think what anybody should be doing, whether actually before or after the changes, is having a look at the assets that they hold, having a look at the shares in the companies that they have, and those shares qualify for business asset relief, business property relief at all, because both now and going forwards they might not do. So people might think they're sitting on an asset that's going to get inheritance tax relief when it doesn't. So really, I think understanding the business and any other assets they've got that they think qualify for relief, so that we can decide whether that the relief applies or it doesn't, because it can be a nasty shock to some estates when suddenly an asset they think qualified for relief didn't, and I've seen that certainly in the past.
Thank you. Thanks, Deb. Just a couple more questions. Whilst I'll ask these two questions, we will have a quick poll. I think my colleague Megan's going to put a quick poll up about today's webinar. So if there's anything we've covered off today that you'd like to speak to us about in a bit more detail, or speak to your local office about in a bit more detail, or understand in fact the impact that some of the changes might have on you, whether you're an individual or business owner or business, then please do complete the poll, which is going to be on the screen for about 1 minute, I believe. But Debbie, a question coming around. So where was it? Are there any changes to EIS and SEIS? Is that one for you or Trevor?
Yeah, no, I can take it, Steve. That's fine. So no, before the budget was announced, the government committed to continuing the EIS and SEIS reliefs that are available. So essentially, they provide you with income tax advantages, income tax reliefs, potentially capital gains tax deferral as well. Now, the investments can be quite risky in return for that, but yeah, there are reliefs available, and they will continue. The government have committed to.
Okay, thank you. One final question, which was linked to BPR, which I'm not. I think you might have covered off, but not be Patrick. It references planning early regarding succession. With the changes in BPR, how can, as a business owner, how can I plan early regarding future succession? I think that's the question.
Yeah, it's a good question, Steve. And again, it probably follows on from Debbie's earlier point. The earlier we start planning, the better. We do prepare what we call kind of option reports for clients who are thinking of succession. So we look at different succession routes that might consider, the valuation, timing, risk, tax implications of various succession routes for clients. And also that can feed into some form of kind of vendor due diligence. So again, if clients want to prepare for a sale event to a third party, we can help with the planning and work with their local advisors, local office, local compliance or legal teams to make sure they're ready when the time comes.
Perfect. Thanks, Patrick. We're bang on 4 o'clock. So thanks everyone for joining us. I know we had a bit of a technical issue during it, but I think we've managed to get it back. So bang on 4 p.m. Any questions which we didn't get a chance to answer, we ran out of time. We'll pick those up separately. So thank you everyone for taking the time to join, and thank you for the engagement, the questions. And if you need anything else, please contact your local office relationship partner manager. And yeah, thank you very much. And we will be holding a few more webinars in the next few weeks. We'll have a bit more of a deeper dive into some of the areas we touched upon today. So thanks all for joining, and have a good rest of the afternoon.